Mr. George Strait, the king of country music, Poteet, Texas. Thank you, George. You got to give it away. It's all over. Good evening, everybody. Professor Hasse here to begin the second half of our business finance course, week 5. And perhaps the most important part of this course over the next 2 weeks, capital budgeting. The determination of borrowing money, issuing stock, taking your profits and investing in growth, new assets. And before you even do it, you determine whether the return on that investment is viable enough to warrant the investment in the asset. And that's the capital budgeting process. For every product that you purchase, for any product or service that you buy, a company does a capital budget analysis to verify and make sure that they can guarantee themselves in most likelihood that they'll get a return on their investment for their investors. And that's the process of capital budgeting. This, of all the functions of a finance office or financial management, perhaps is the most important in corporate finance. Before you even invest the money in a new market, in a new plant, in people, is the expected return generated off that investment going to warrant enough to satisfy the needs of the investors who gave you the money to do this investment? And that's the process we'll be talking about here in chapters 8 through 12 over the next couple of weeks. This is the process that you'll be doing as teams in the Road King trucks case analysis, which I hope some of you have begun to get in contact with your fellow team members. I will be having a special video lecture this Saturday. You don't have to come. It's a video lecture. It's not, you don't have to show up. And that video lecture will go over the key points of the Road King case and what you have to find out as a team and what you have to analyze. I decided not to do that tonight in this lecture because we're just learning about that process tonight. And I didn't want to confuse too many of you, kind of keep them in separate parts to get you able to digest what we're going to be doing tonight. And then we'll talk about it in a special lecture over the weekend that you can concentrate on. So that's my method to this madness. Most of us have posted our midterm grades. I am in the process of grading them now, and all the grades will be posted by Friday. Now, let me explain to you a little bit of the midterm grades. Up to this point in time, including the midterm, we've roughly had about 1/3 of our course completed grade-wise, about 1/3. And at this point in time, once the midterm examination grades are posted, you'll have a fairly decent idea of where you stand in this class through the halfway mark. And what I do with those grades is I don't publish them. I don't report them to the registrar. I don't report them to anybody. But what I do is if I feel that you might need some help or some guidance or some tips on studying in this last half of the course, I will be in contact with you via email and say, you know, you got a C average. I think you can do better. Is there anything I can do? Is what can we do perhaps to get this better for you? So if you get one of those emails, don't get all defensive. Don't get all, who's he think he is? I'm doing this to help you. So if I feel my assessment of you through the first 4 weeks or 1/3 of the graded course and 1/2 of the actual physical course, if I feel that maybe, because I know what you're going to be doing in the next 4 weeks, and if I feel you're not prepared, or maybe you have to change some of your study habits because it's really going to be picking up the pace, as I'll mention in just a minute, over the next 4 weeks. And I know a lot of you have responsibilities. You have other classes. This ain't easy. And so I want to be able to help you and get you prepared for these last couple of weeks. So I might be getting in contact with you if I feel that you might need some help. I like to schedule in the second half of every class weekend tutoring sessions or weekend sessions when I can be available for students on the weekend to come on via Zoom. In the old days, I used to meet on campus, but now via Zoom, where we could go over things, maybe help you in your study techniques for this class, maybe help you with learning how or using a spreadsheet. So a lot of things that we can do to make sure that you get your skills up to speed over the last half of the course. And don't take that as negative. That's a help. It's helping you. And I hope you take it in that spirit. So that's where we're headed to with the midterm grade and what it tells us, what it tells you about your status in this class up to this point in time. Also, I can't stress enough the need, it's important that you come to these sessions on Wednesday evening, but it's even more important for you if you cannot attend or you come in and out due to technology issues or whatever's going on in your life, to make sure you watch the videos that I'm recording of this lecture, because they'll help you immensely as you get to do your work over these next few weeks, okay? They will help you a lot. So make sure if you can't be here for the full time, the couple hours that I'm here on Wednesday, if you have to go in and out, if you're having technology problems, make sure you take the time and watch those videos. They will help you. Take notes during those videos. Stop the video. Replay the video. That's what they're there for, is to act as a study tool as you're moving forward. Okay. In week 5 this week, I have some new little tidbits, and I mentioned that in the introduction video to this week yesterday. And I always find that this is very important for students to see so they can get a handle on what's coming up over these next 4 weeks. The midterm exam for many of you, you've already posted. That's 20% of your grade. So after the midterm exam is posted, again, we'll have roughly a third of the course grade-wise completed. Not this week. There's no graded work this week. Next week, I will post assignment number 3, which will be a practice of a capital budgeting analysis that we're going to talk about this week and next week in our lectures. You'll be actually doing that. You all have to do this in your Road King case paper as well, this spreadsheet analysis. That's what assignment number 3 is. It's a spreadsheet file that you'll be doing. I will give you a template to help you. And that's next week's assignment due October 5th. Then the next week, your group case paper is due. Now you can get an extension on that, but it's officially due October 12th, the second to the last week of class. And that's 20% of your course grade for your team work. The final examination will be posted the last week of class, and it'll be due on Tuesday, October 19th, and that's 30% of your grade. So as you can see, over the next 4 weeks, 55% of your grade will be determined by assignment 3, the group case paper, and the final examination. So a lot to do, a lot to be aware of. Then if you, on that final week or that after you post your final examination on the 19th, if you do your course evaluation and get that posted by the 21st, on Friday, October 22nd, you'll get your course grade posted to Blackboard, and you'll find out what you're doing. So that's the timeline, and that's some key important dates that we have coming up over these next few weeks. So jot them down, take a picture of it, refer to it, put them in your notebook, put it on your desk, so you know when things have to be done over the next few weeks. There's no graded work this week. That's why we're going to concentrate on the capital budgeting analysis today, and we're going to concentrate on the weekend with a video about the Road Kings case to get you prepared for your team to tackle that situation. The toughest thing about the Road King case isn't the spreadsheets, isn't the work, because I give you templates for that. You just have to match them up. The toughest part of the Road King case is making sure you understand the terminology and how the data is given to you. That's the toughest thing. And that just requires concentration and practice. And we'll highlight that. And I'll highlight some of that today and highlight some of that on the weekend for that Road Kings video. So please take the time to watch these videos. They will help you immensely. They'll help you enough where if you pay attention to them, and trust me on this, you'll get an A in this class. If you blow them off and don't pay much attention to them, you're going to get a B or worse. That's how much they can help you. So pay attention to that and you'll do fine. And I think as some of you are finding out, even in maybe your other classes, if you're taking any other classes now, is that on these new calendars of 8-week courses, you have to be engaged quickly. You have to pay attention to the material quickly. You have to understand what's demanded of you by your professor quickly. If you do that and work it into your schedule, you'll get through it and be just fine. Okay, so note these important dates. Here's a spreadsheet file that I'll be using this evening. It's week number 5 lecture spreadsheet. You can download it now and follow me through my lecture this evening. We're going over these 2 problems at the end of chapters 8 and 9. Where are they here? Problems 1 through 8 on page 264 and problem 14 on page 296. 2 perfect examples of the material in chapter 8 and chapter 9, and these are all key components of the capital budget analysis. And what is a capital budget analysis? Here's a great definition in your Blackboard defining this process of capital budgeting. Capital budgeting is the process in which a business determines and evaluates potential expenses or investments that are large in nature. In other words, capital projects. These expenditures and investments include projects such as building a new plant and/or investing in a long-term venture. Oftentimes, a prospective project's lifetime cash inflow and outflows are assessed in order to determine whether the potential returns generated meet a sufficient target benchmark, also known as investment appraisal. In other words, if we all worked at Apple Computer, and Apple Computer came to us today and said, hey guys, we want to invest in a new iProduct, all right? A new iProduct. And we're thinking about having an investment budget of $500 million, $500 million. We would like you to put together a capital budget analysis of this project. And what do you think, what kind of money we think you can make from it? What's going to be the expenses of setting this up? And we'd like you to do this before we even start spending any money. This project is not due until 2030. It's now 2021 and we're beginning this project. And that's really how they work at companies. They do it well in advance before they want to have the project or the investment get to market. And they go through this capital budgeting process. And if any of you are going to be in a career of finance, accounting, corporate management, distribution, sales, marketing, this concept of capital budgeting you'll have in your career about assessing the return based on the efforts of your appropriate area of expertise in the company. So read through these definitions, they will help you. And if you haven't already done so, look through these videos that I've provided. Okay, so that's where we stand this evening. Does anybody have any questions or concerns before I get going? Boy, you guys are easy. Mr. Hillick.
Thank you. I'm not going to be able to attend on Saturday.
You don't have to attend on Saturday. As I said, it's a video lecture. There's no need to attend.
And you're going to post that?
Yes, sir.
Awesome. Just wanted to make sure. I thought
Yeah.
so. Thank you.
Yes, I mean, Saturday, the USC is going to lose another game. On Saturday, the Dodgers are going to lose another game. On Saturday, you want to spend time with your family. Dustin, looks like you got to clean up the house a little bit. So you have other responsibilities. That's a joke. You have the other responsibilities. You should say the same thing for me here. So I'm just doing a video lecture that I'm posting the video lecture Saturday afternoon, and you can watch it at your leisure over the weekend or into the next week. You don't have to attend. That's not the purpose of this. All right, good. Thanks. Good question, though, Dustin. Thank you. Any other questions or concerns by our distinguished financial managers? Okay. Then let's begin. I'm on page 296 of the textbook, and I wanted to just show you this problem before we tackle it. This is a simple but perfect example of part of the steps that we have to do to determine whether we should invest. And in this case, there's two projects, Project A and Project B. Project A is going to require an investment of $200 in the asset. And that $200 is going to produce a net cash flow profits of $80 a year for 4 years. The other project, Project B, is also going to require a $200 investment in an asset. And that asset is going to generate $100 a year for 3 years. The question on the table in this problem is, which project would you recommend that the company select to invest in, to invest the $200? Okay, that's the analysis. What should we do? Two different projects, one with a 4-year life and one with a 3-year life. One with $320 of net cash flow over 4 years, one with $300 cash flow over 3 years. Now, the first question that especially you accountants in the audience should know or would ask, Mr. Hasse, why is Project A 4 years and why is Project B 3 years? Well, the simple answer to that is that's the depreciable life of that asset. Okay, that's the depreciable life. So the analysis is based on, you might invest this $200 in Project A, and you might own that investment for 20 years. But as far as financial management analysis is concerned, the analysis is only for the depreciable life of the asset. Who sets the depreciable life? Uncle Sam, the IRS. They set the depreciable life. Usually your public accountants or your controller of your organization will figure that out. And that's the depreciable life. How long you can depreciate it is the life of the asset. And that $80 a year for 4 years and $100 a year for 3 years, that's the net revenues minus expenses for that project. In chapter 9, we learn how to calculate how we get those $80 and $100. And that's what the problem 14 is that we're going to look at later on. That shows us how to calculate that project cash flow. And that's chapter 9. Chapter 8 is concerning, it's called return analysis. What do we need to do to determine which is the better project, giving us the biggest return, A or B? That's what we're doing here. And if you notice the first line of this problem right here, The opportunity cost of capital is 11%. What that means is to get this $200 to invest in project A and project B, it's costing the company 11% to get the money. Either borrowing it, either issuing stock, or using profits from a prior period to invest in the asset. That's costing them 11%. For example, let's say you were going to buy a car and you have all cash. You're not going to borrow any money. So you buy that car and the car is $25,000. So fortunately, you have some money in your savings account or in a money market account that you've invested, that's invested every month, and you have $30,000 in that account. So you're going to take $25,000 out of that money market account or that investment and buy a car for cash. What is your cost of capital? The money you are losing by taking it out of that investment. Let's say the money market account on that $30,000 pays you 1.5% a year in interest. So your cost of capital for the car is 1.5%. That's what you're giving up to take the money out of your money market account and invest in the car. Another example would be, let's say that I don't have $30,000 or $25,000 in a money market account. I'm going to borrow the money to buy the car. Your cost of capital then would be the interest rate on your car loan. That's your cost of capital for that. So the cost of capital is what you have to pay or what you're losing. That's why it's called, in this case, opportunity cost. What are you giving up, sacrificing to take that money and invest it in this project, A or B? It's 11%. It's called your cost of capital. And that's what chapters 10 and 11 are about. How do we calculate that percentage? So that's future attractions. But it's given to us in this problem. Our cost of money is 11%. It cost us 11% to get to $200. Now there's 4 criteria that are talked about in this problem. And maybe if some of you have, and if you looked at our Blackboard, I give you the definitions of these 4 criteria of what you have to know as a result of investment analysis. It's called net present value, internal rate of return, profitability index, and payback. Those are the 4 investment analysis that you're going to need to know for the Road Kings case, for assignment number 3, and for the final examination. You're going to need to know what they mean and how to calculate them: net present value, internal rate of return, profitability index, and payback. And we're going to do the first look at those calculations in this problem here. So this is going to require some spreadsheet work. And that's how we do it. So I've set up a spreadsheet already to do this problem, to find the answer of what is the better project, A or B. So let's take a look at that spreadsheet. Here it is right here. Chapter 8, problems 1 through 8 at the end of the chapter. Here's that setup that we just saw in the textbook. Project A with a $200 investment, with $320 being profit or cash flow over 4 years. Project B, excuse me, with a $200 investment with a $300 return. Now, just looking at that, you would probably say, hey, I'd go with A. I'm getting $320 back compared to $300 back. But then I'm sure some of you might say, wait a minute, I'm getting the $300 in 3 years. In 3 years, I'm only going to get $240 from Project A. So isn't Project B better? Because I'm getting $300 faster, even though I'm getting more in Project A. That's another way of looking at it. And this is why we have it's important to have what is our cost of capital, that opportunity cost we are talking about. That is called the discount rate. Remember, year zero is today. Let me put that here. Year zero is today when we're making the investment of $200. And then on that investment over the next 4 years, we're generating this cash flow. So the purpose of this analysis is to take these future, excuse me, to take these future cash flows and discount them back at our cost of capital, 11%, to what they mean or what their value is today. Because then we compare that to the investment to determine whether we're getting a return or not, and that's called net present value. These 4 calculations, NPV, dollars, internal rate of return, percent, profitability index, ratio, and payback in years, are 4 different ways of looking at the same data. And you might say, Mr. Hassey, can't we just do one way? Why do we have to do 4? Because in the real world, many companies look at this different ways. Some companies like to look at the return in dollars. Some companies like to look at the return in a percent. Some companies like to look at the return in a ratio. And some companies like to look at the return in years, or all 4. And do they say something different? And in this example here, all these 4 ways give us different interpretations of these 2 projects. So here we go. The first calculation is to determine the net present value. And that's where we have to calculate what is called the discounted cash flow. The current value in today's dollars of these $320 we're getting over the next 4 years. And we discount these $320 back to today at 11% our cost of capital. Here's the calculation. Formulas, function, financial, and we look for the function NPV, net present value. And we have to put in 2 sets of numbers. The first number is what is our cost of capital, the interest rate, 11%. And then we have to put in the cash flow over the 4 years going forward of this project. So all I have to do is in that little section of this logarithm, go to my information and just paint from year 1 to year 4. And now they've put in the values of $80 over these 4 cells. And now it's going to discount this $320 back at 11%. And I hit OK. I get $248.20. This $320 is now in today's dollars, when we're making the investment, $248.20. And our net present value is the difference between that discounted cash flow and the investment today. So the answer is, for project A, the NPV is $48.20. Well, let's do it for project B. Same way, we have to determine the discounted cash flow, formula, function, financial, net present value, NPV. The rate is still 11%. That's our cost of capital. And the values here are years 1 through 3. We discount those back at 11%. We get $244.37. So in this case, the difference, or the net present value, is $44.37. Darlene, question.
Yes, Professor. So in the formula, it assumes years for the time
I didn't
frame.
hear. I didn't hear you properly. It assumes what, Darlene? I didn't hear you.
the time frame is years in the formula always,
Yes,
or is that
yeah.
just
When
okay.
you put in the values that way, B5 to B8 or C5 to C7, it knows that it's over a period of time. For each value is 1 year. It knows that. That's what's so nice about Excel spreadsheets or any spreadsheets. It does that for you. Okay. So here's our answer. It looks like project A has a little bit better return than project B. Same investment, different cash flows over different periods of time based on the depreciable life of those particular projects or investments. Same cost of capital. You do a discounted cash flow over the periods of time, you get a $48.20 NPV. You get a $44.37 NPV for project B. Project A is returning more money in dollars. Now let's see what that is in a percent. And that's what the internal rate of return calculation is. It's determining the return rate in a percent, not in dollars, but in a percent. Let's do it for project A. Formula, function, financial, internal rate of return, IRR. There it is right there, IRR. And this is really simple. You hit OK, and all you do under values is paint, in this case, from year 0 to year 4. Year 0, you include year 0 now in the IRR calculation, where in the discounted cash flow calculation, we included just year 1 through 4. This is year 0 through 4, B4 through B8. And now I hit OK, and boom, 21.86% is my return on this investment over 4 years. Let's do the same for project B. Formula, function, financial, internal rate of return. Now the values are year 0 through year 3. Just have to do up to 3 years, but we include the investment year as a negative. And look what happens. 23.38%. Hey, wait a minute, Mr. Hasse. Project B has a greater return than Project A. How can that be when Project A is returning more money than Project B? And I'm sure you guys could probably know that answer. The reason is we're getting the money quicker. We're getting the money quicker in this project, thus the return is a little bit higher. Even though Project A is giving us more money, you're getting the money quicker in Project B, thus the return in a percent is 23.38%. So some companies might say, nah, yeah, we're going to go with Project B. That we're getting our money quicker. That's a better return. And other companies go, nah, we want more cash. So we're going to take Project A. Okay. Welcome to the world of financial management. It's all in interpretation and what you're looking for, the interest of your particular company. Now let's take a look at this analysis in terms of a ratio. And it's called the profitability index. The profitability index is the relationship of the discounted cash flow to the investment. What is the relationship in a ratio of discounted cash flow divided by the investment in a ratio? So I just put in that formula, equals discounted cash flow divided by, and remember this investment is in a negative number, so I put this as a negative to wipe out that negative index here for that cell, and I hit OK or enter, 1.24. That's the ratio. We're earning in discounted cash flow 1.24 times greater than the investment. The ratio or profitability index is the relationship of discounted cash flow to what the investment is. So if we do that again for project B, it's 1.22. Again, project A is based on the discounted cash flow, which is higher. So project A will have a higher ratio, profitability index. Okay. And the last return analysis, let me just save this here. There's nothing worse than going through and doing all these calculations and then something blows up. I can't tell you, in the last couple of weeks, not in this class, but in other classes, I've had students calling me and in sheer panic. One young lady was crying her eyes out. Mr. Hassey, my dog knocked over my water on my laptop and fried everything, and I had all my examination on that, and I lost it all. Did you back it up? No, I was working on it at the same time. Oh, okay, well, take some extra times, you'll have to do it again. But always try to run a backup or run a copy or save it as you're doing this, because that's very important. And I probably don't even have to tell you guys this, you know that. What's the payback in years? Now, the payback in years is no discounted cash flow. All it is, how long does it take us to recoup our investment in straight dollars? That's the payback in years. How long does it take us to recoup our investment? Well, the investment is $200. So $80, 160, 240. 240. So somewhere with it between years 2 and 3, we have paid back the $200. Well, how many years? Well, that's pretty easy. 80, 160, and how long do I take until I get the $200? $40 of this 80. I get 80, 160, 200 with the $40. 1, 2.5 years. Half of the 80, 40. So my payback in years is 2.5 years. My payback in years for project B is even simpler. 1, 2. 2 years to pay it back. Where present value, rate of return, and profitability all include the cost of capital in that type of calculation. Payback is strictly dollars compared to the investment in cash flow. How long until we recoup our investment? So notice a pattern here. Project A is better for NPV and for payback. Project B is better for internal rate of return and profit, and excuse me, I screwed that up. Good job, Mr. Hassey. Way to screw up make your students go bananas. Project A is better for NPV and profitability index. There we go. And project B is better for internal rate of return and payback. So each project in its own way is beneficial to the company. Now the company has to interpret, what do they want? Dollars, return, payback? Now it's the company's determination of which project they can select. They can't select both of them because they only have $200. So they got to pick one. So now it's a case of interpretation, expectations about what the company expects. And this happens all the time in the real world. So 2 analysis say project A, 2 analysis say project B. Kind of weird. But the key thing for you all here is understand the concept of what these mean and how to calculate them. That's what you guys got to worry about in assignment 3 next week, and the Road Kings case, and the final examination. You're going to get this type of exercise in all 3 of those assessments. So at the end of class today, I'm going to post this completed file back to week 5. So you have that as the beginning of a template and the beginning of a resource for this information. The textbook has all this, but they kind of do it in a way that's very confusing. So that's why I walked through this in this exercise. It kind of makes a little bit more sense. So this is a great recording to have if you get confused about what the definition is of NPV, what the definition of IRR is, what the definition of profitability index and payback. And you can just look in the cells for those calculations and how we came up with it. Anybody have any questions on this analysis? Clear as mud, huh? Okay. Now this is chapter 8 right here. Understanding these 4 techniques. Understanding them. Now they give you 2 other techniques in the chapter. One is called marginal payback, marginal internal rate of return. But I don't see those as viable analysis for the real world. These are the 4 that most companies use. When I had my business, I used net present value and internal rate of return, those 2 methods in my analysis. If I had to put together a bank business plan or a bank presentation of a possible investment, I used NPV and IRR as my investment analysis to show a banker, to show potential investors about what I'm going to generate off an investment. So these are important concepts. Now, in chapter 9, we're going to learn about, all right, where did this $80 come from? All right, it's great, it's given to us, but no, we don't live in that perfect world. We as financial managers, we're going to have to calculate, where does this $100 come from? Where does it come from? Remember, it's called net cash flow. And net cash flow is net income, which is revenue minus expenses, plus or minus working capital, plus depreciation, plus salvage value. Holy moly. Now this is getting to be heavy duty stuff. This $80 and this $100 is called net cash flow. And it's the product of an analysis that determines what's the projected net income off the project, how much working capital are we going to need, adding back in depreciation because it's a non-cash expense, and how much is the asset worth at its end of its life, and can we sell it to get any scrap or salvage value after taxes. This is the formula to determine these numbers as discussed in chapter 9. And we're going to look at a problem in chapter 9 that asks us to calculate that cash flow. Okay. And this is where this gets to be a little intense. And that's why you have to just practice. And we're going to practice them over the next couple of weeks to get used to them. And this is a good study guide, this template to do that. Okay, let me save this and let's go back to our textbook. Let's go to chapter 9. Let's go to page 296. Here it is right here. Page 296 and 297. Okay. Now we're going to, remember as I said earlier, now we're going to have to calculate what is the cash flow for every year. Then we do the analysis. And in this problem, you have to determine what is the initial investment in year 0? How much are we investing? How much is the working capital requirement? And I'll define that in just a minute. What is our revenue and expenses? And with a cost of capital in this problem of 12%, what is the NPV and the internal rate of return? So we're going to do the same process here as this problem, NPV and IRR, but we're going to come up with these numbers. They're not going to be given to us. We got to figure them out. And that's the challenge. And for a lot of us, this is going to be a challenge going forward, especially if you're not a numbers person. There's some accounting here. Net income is net accounting income, revenues minus expenses. Then cash flow is taking into account working capital, depreciation, and there's no salvage value in this problem, so we don't have to worry about that. But we will have to worry about it in other problems. But that's next week. So our job is to put together and piece together problem 14 on page 296. Now I'm going to take a 1 minute cone of silence for you to read this problem on page 296, 297. You can read it right from the screen here. So I'm putting the cone of silence over me for about a minute, and I would like you to take time and read this problem, please. Go. Anybody got a cigarette? Excuse me. Okay. As I'm dying here, excuse me. Went down the wrong pipe. So we have to determine a couple of things. As I said in this problem that we just looked at, Darlene, do you see my spreadsheet here? Do you see my spreadsheet in front of you? Okay, I thought so. Hang on. There we go. As we determined in the problem that we just did in chapter 8, we determined what the investment was that was given to us, what the yearly cash flow was, and then we went ahead and did the calculations. Now in chapter 9, we have to determine, okay, what is the investment and what is the cash flow? Then we can do the calculations. That's chapter 9. That's what we're going to do in this problem. And remember, cash flow is net income. And remember, net income is equal to, this is back to our old accounting days, revenues minus expenses. And what are expenses? Variable and fixed expenses, depreciation, we keep that separate, and taxes. Those are our expenses. So we have to determine what are our revenues, what are our expenses, what is the depreciation schedule, and what are our taxes. Once we figure that out, we get net income. Then we have to figure out working capital, and we already know depreciation, And in this problem, this particular problem in chapter 9, there's no salvage value, so we don't have to worry about that. But we will have to worry about it in other problems that we'll do next week. So going back and looking at this problem, let's determine these key things. So I'm going to go back and forth here on the problem, so bear with me. I have a spreadsheet already set up to handle this problem. They tell us in the problem that its lifespan, its depreciable life, is 4 years. So we got that down, 4 years. Year 0 is today when we're making the investment. We're going to have to determine in years 1 through 4, what are the revenues? What are the expenses? What's the depreciation? And then we determine the earnings before taxes. We take out the taxes, and they tell us in this problem that the tax rate is 40%. And once we do that, we'll determine the net income. Then we have to determine the working capital requirements of this case and depreciation. Once we do all that, we will get the net cash flow. And once we did, that's like the $80 and $100 that we just saw in problem chapter 8. Once we have that, we can now determine the discounted cash flow with a cost of capital of 12%. And we can determine the internal rate of return. And I added the other two calculations just for the heck of practice once we get to that point in this problem. So our job is to fill in these blanks. This, ladies and gentlemen, is what assignment 3 next week will be all about, to fill in these blanks on a spreadsheet. That's what you're going to do in assignment number 3. And this, ladies and gentlemen, is what you're going to do twice in the Road Kings case for 2 different products. Twice you're going to fill in these blanks in a spreadsheet. And this, ladies and gentlemen, is on the final examination. I'm going to give you a capital budget analysis already completed with all the numbers and all the net present values and all the conclusions. Your job in the final examination is to interpret what that tells you. I'm going to give you all the calculations. You have to tell me what it tells you about this project. That's the final examination question on this. So that's coming attractions. But the key thing now is let's determine how do we come up with all this stuff. And I want to concentrate now right off the bat before we start filling in numbers and getting numbers going every which way on this, is the definition of working capital. There it is right there. Working capital. Let's highlight that here. Let's put this right. Let's do that right there. What is working capital? Why is that a cash flow item? Well, here's the example I like to use with students. And Darlene, I'm going to pick on you because I can see your lovely face. Let's say Darlene wants to go out and buy an automobile. She needs a car. She's sick of taking the bus and the train to work. Enough of this nonsense. I'm going to buy a car. And she now has gotten to the point in her financial life where she has a down payment and she has the credit that she can go out and get a car loan. Cool. So Darlene goes out to a dealership and picks the car she wants, finds the cost, how much she can put down. She gets the car loan. They give her the money. She now has to start making payments in the future, but now she has the car. So just pulling a number out of thin air, let's say she pays $30,000, both the down payment and the car loan, for a $30,000 automobile. She has now purchased an asset. That asset is going to give Darlene a return on her investment. Why? She doesn't have to ride the bus anymore. She doesn't have to take the train, the Metrolink. She has her own car. She can do whatever she wants. Okay? But it cost her $30,000. But does Darlene's cost of that car end with her purchasing $30,000 car? No. She has to register the car. She has to get insurance on the car. She has to pay for gasoline on the car. She has to do maintenance into the future, oil changes, new tires as she uses the automobile. What is the definition of gasoline, registration, insurance, maintenance? You know what that's called? Working capital. That's working capital. So any investment continues to have costs associated with it long after you purchase it. And that's the definition of working capital. So if you go out and buy a car and think, oh, geez, I don't have to worry about expenses anymore. I just paid $30,000. I'm done. Boy, are you in for a rude awakening. You have to budget. You have to allow enough cash available so you have insurance and registration and gasoline and maintenance so you can drive and use the asset to give you a return on the investment. That's exactly what it means in this case in financial management. In addition to the investment, we're going to have working capital. Now, how is working capital measured? As a percent of revenue. As a percent of revenue. That's how it's measured in this class and in corporate finance. It's measured as relationship with revenue. If revenue goes up or down, your working capital needs go up or down. Okay, I wanted to get that definition out of the way before I start throwing numbers at you. Just to understand what working capital, because to me, teaching this subject for 35 friggin' years, the toughest thing for students to grasp is, well, what the hell's that working capital thing again? Remember, what we're trying to find out here is the investment today, is it generating enough cash flow into the future to warrant that investment? That's what we're doing. So let's go back to the problem. Take a look at it. Let's get the investment out of the way, first of all, in year zero. All right, they tell us the revenues. Here's our revenues. Cool. They tell us our working capital, but let's say the product requires an immediate investment of $45,000 in plant and equipment. Thank you. So this project, the investment in the asset is going to be $45,000. Cool. So let's go back to our spreadsheet. So right here in year zero, we'll put minus $45,000. Boom. That's the investment today. That's how much we're borrowing, spending on the asset, $45,000. Okay. Back to the problem. What revenues are we generating from this? And I'm sorry to go back and forth, but I don't want to lose people on this, so that's why I'm doing this. So notice the revenues being generated, sales off this investment of $45,000 in this plant and equipment is generating $40,000, $30,000, $20,000, and $10,000 a year in revenue. Okay, got it. Let's put that in our spreadsheet. $40,000 in revenues the first year, 30,000 in the second year, 20,000 in the third year, and $10,000 in the fourth year. That's $100,000 over 4 years. An investment of $45,000 is generating $100,000 in revenue into the future. Boy, right off the bat, you say, oh, this sounds like a pretty good deal. But now we have to include expenses. What is it costing us to get this $40,000, $30,000, $20,000, and $10,000 a year? All right, let's go back to the problem. Here it says here, they give it to us in a little different way. Expenses are expected to be 40% of revenue. Well, and a lot of companies work this way. It's called operating margins. It's called cost of sales. 40% of revenues is expenses. Okay, back to the spreadsheet. So here in our spreadsheet, all we have to do for expenses is say equals the revenues times negative 0.4, $16,000. That's 40% of revenue. So right now, based on that formula that they're giving us in this problem, 40% of revenues is an expense. So that's money coming in is the revenue, money going out are the expenses. And now the cool thing about it is I have this in this cell. I can just slide this over and copy that formula all the way down. I love spreadsheets. So there's my expenses. That's operating expenses. Maybe the cost of the materials, wages, advertising, all kinds of things. 40% of our revenue. Now we also have to do depreciation. Now, the first thing I would do if I was a student, and I did this way back when I was learning this, is why are you keeping depreciation separate? It's an operating expense. That's how I learned it when I took accounting. It's an operating expense. Why isn't depreciation there? Why? Because depreciation is going to be added back in down here. We want to keep that separate so we know what it is. Depreciation is a not, let me write this down here. Depreciation is a non-cash expense. It's an accounting transaction. That accounting transaction is allowed to us by generally accepted accounting principles to expense assets over a period of time by a journal entry. Remember those days? I miss those days. Adjusting journal entries. The good old days. Okay. So that's what depreciation is. So it's a non-cash. So here it's part of our expenses, but we're not spending any money. So we're going to add it back down here to determine our cash flow. So what is depreciation in this problem? If the plant and equipment are depreciated over 4 years to a salvage value of 0 using straight line depreciation. That's why I had to take accounting for this class. By taking accounting, I know exactly what the hell they're talking about here. Straight line depreciation is taking the cost of the asset and dividing it by the life or the years of the asset, right? And there's no salvage value here, so we're going to fully depreciate the $45,000 over 4 years. Got it. I'm so glad I had Mr. Hassey as in accounting way back when. Did I have any of you back in accounting way back when? I don't think so. All right, let's go back to our spreadsheet. I'm getting seasick going back and forth here. I apologize. So what is our depreciation? Equals our investment of $45,000 divided by 4 years, the 4-year life. And I'm going to put that as a -4 because I want this to be an expense. So 45,000 divided by 4 years, $11,250 a year is my depreciation. And I'm just going to take that and slide it all the way over. And there's my depreciation expense. And why I'm doing this, I'm going to go ahead and add it back down here as cash flow for the project. To determine net project cash flow, I'm adding it back down here as adding it back in because this is a non-cash expense. So what is my earnings before taxes? It's revenue minus expenses minus depreciation. So let's do that. $12,750. And let's just slide that over. And there, ooh, look at in year 4, we're losing money. Son of a pup. We're losing money in year 4. That's interesting. Good to know. Because of that depreciation expense, we're losing $5,250 in year 4. Okay, so our tax rate is 40%. which is a little high for 2021, but we'll live with it. Remember in the problem, they tell us that the tax rate of this company is 40%. Now, what does that 40% represent? That represents the taxes of federal tax, corporate tax, and represents whatever state this company is doing business in, the state corporate tax. Right now, on September 22nd, 2021, for businesses in California, their corporate tax rate is about 27%, including federal and state corporate tax. It's about 27%. It's gone down because the Trump administration reduced corporate taxes in a couple of years ago. And so it's gone down to about 27% for most companies. Okay, just a little tidbit there. So let's take 40% of our earnings before taxes. So equals times minus 0.4. That's our tax rate. And there's our taxes we have to pay on our profit. This earnings before tax is another way of saying it's our operating profits. Now we got to take taxes away. So let's slide that down and watch what happens in year 4. Hey, we get a refund of $2,100. In year 4, we lost $5,250 of earnings before taxes. So because we lost money, 40% of that is a refund that we get that year. Cool. But all the other years, we're paying tax on our operating profits. So now I can determine my net accounting income. Revenues minus expenses equals operating profits minus taxes equals net accounting income. So there's our net income for year 1. And notice our net income in year 4 is a little bit better because we get a refund because we had losses in year 4, but we still lost money. So there's our net accounting income generated by this $45,000 investment. Now I'm going to save this right now. We're going to take a little deep breath and take a look at what the hell Mr. Hassey just did. Remember I told you there's going to be numbers flying every which way, and you can lose track of all this as time goes on. What we've done here is we determined our accounting profits based on the information given to us as variables, in this case, given to us by the project, of an investment today of $45,000, generating $100,000 of sales, with our expenses being 40% of that per year, with a depreciation schedule of straight line over 4-year life of the 45,000, a tax rate of 40%, and voila, our net income. Mr. Hassey, you make this sound so easy when you say that, but it's not. It's like putting together pieces of a puzzle. You're going to have to do this in assignment 3 and the Road Kings case. Put together the pieces of the puzzle. What is our investment? What is our revenues? What is our expenses? What is our depreciation? What is our tax rate? That's the challenges that you all have to do in this case, or in any case now. What I advise you all to do at the end of this class, if you're so inclined, is to save this spreadsheet, but then maybe make a copy of the blank one right now and try to do it on your own. Try to do it on your own, and you use this as an example of the answer. But see if you can do this on your own and recreate the formulas, recreate the numbers, and try to do it on your own and see if you can do that. It's good practice. You don't have to do that, but that's how I would study it. Trust me. Okay. Now that I got that out of my system, notice I've added back in, hold it, let me time out here just for a minute. Rudy, you with me on this? You following it? Why are you sitting in the dark? You look kind of creepy. All right, you're all right. Brittany, what's going on tonight? Anything I should know about?
Nope.
Exciting, huh? All right. If this is the most exciting part of your day, you need to reevaluate your life. Okay. Paulette, what's going on?
Hey, not too much. The market fell yesterday.
I've taken it in the shorts on my Apple stock the last month. This is getting ridiculous. It's cutting into my vacation and golf plans. This is nuts.
Yes.
I have a wedding anniversary coming up, and right now our wedding anniversary is going to be at El Polo Loco for dinner. That's about it, because this market is driving me crazy. All right. I'm going to say this right up front. I'll probably, here is Bader. Here's Bader. Everybody say hi to Bader. This is our family cat. This is
Okay.
Bader. Bader has a big birthday coming up next week. Next week, she'll be 2 years old. There she is. Okay, that's Bader. Now, Bader knows a lot about this because she's heard so many lectures about this over here. Now she's got her face. There's her ears right in front of the camera. Bader, what are you doing? Come on now. All right. Hey, Paulette, what's that? Yes, I know the market is going crazy and it's driving us nuts. And I'm anxious to see in our next assignment or a couple down the road how our portfolios have changed. We did that valuation in our midterm. I'm anxious to see how everybody's portfolio has changed. But the big market made a big change yesterday after you did your portfolio calculation. So we'll see how that's going. Paulette, just tell me, what is that background there behind you? What's that? What is that scene there?
This is a background of just a bar and what is it?
A bar?
Well, there's a bar and
Oh, it's like a house. It's a house.
yeah, it's a house scene.
Very nice. Very nice. I had a student in my class on Monday night, which is a MBA class on corporate finance, and they had one of their background. He was in a jail cell. I was cracking up. I go, what's with the jail cell in your background? He goes, well, I'm going to be a business guy. I might as well get used to it. Very nice. Nice attitude. But it was kind of refreshing how he had a jail cell as his background. I go, are you calling from LA County Jail? He goes, no, that's just a picture. Oh, okay, good. All right, Catherine, it's good to see you. Now, why I have you all here and you're all attending, I am not going to be available tomorrow night for my office hours. I have a commitment that I have a retirement dinner of a friend of mine who's retiring from a company after 45 years. And I am the, what do you call it? I'm the master of ceremonies at this retirement dinner. So I have to take my rather boring personality and do this dinner tomorrow night. So I will not be available. But if you do have questions or concerns about any of the material, please feel free to email me, or I'll be available this weekend if you need to talk to me. So, but I will not be available tomorrow night. Catherine, you have a question?
I was just going to say, maybe you should play some of your great music at the the master of ceremonies tomorrow night, because I love your music choice.
Well, thank you. That's very nice of you. But this guy, he's a CPA. So let's just say I got to watch myself here because I was a CPA at one time, so I can get away with saying this. But let's just say he's not the most exciting person in the world. And music to him is, let's see, I can't even say what his favorite music is. So I'm going to be, if I start throwing out Motown and all my other stuff on him, he won't have no idea what's going on that. But he's a very nice man, and he's retiring after 45 years, and God love him. And now he and his wife are going to go on a trip around the world for 8 months. They're going to travel around the world from Los Angeles all the way around the world. And they're going to end up in Hawaii and then coming back to Los Angeles. Talk about a nice trip. Oh my God. So that's kind of exciting. So he's an accountant. So needless to say, he's stolen or been a penny pincher all his life by being an accountant. So he's probably got all this money held up all over the world and he can spend it. Now, I just offended our accountants in our audience, but I apologize for that. But so that's a nice thing. Okay. So again, I will not be available tomorrow evening, and I apologize for that, but I hope you understand. Okay. Now let's get back to our exciting chapter 9 problem. Here we go. There it is. Okay. Now we have to concern ourselves. We've already known what the depreciation is. There's no salvage value. So how do we determine working capital? Okay. And now if we notice this line here in this problem, working capital required in each year is expected to be 20% of revenue. Working capital required in each year is expected to be 20% of revenues. Okay. Now, working capital is defined as current assets minus current liabilities. So it's not like an expense or an income statement item that has one number one year and another number another year. This number is going forward from year to year to maintain 20% of revenue. So let me show you that here. So based on that formula, in year 0, because we need to have working capital available to get the project up and running, besides the 45,000, if we take equals year 1 revenue, 40,000, times negative 0.2, there's our working capital, $8,000 for year 0. In other words, that's 20% of year 1 revenue. You get that? That's how I calculated that. Rudy, nod your head. In the dark. You're creeping me out there by in the dark. I don't like that, but that's all right. That's how you like it. All right, now look, what do we do for year 1? Well, year 0 was 20% of year 1. So year 2 has to be 20% of year 2, right? 20% of year 2 is $6,000. So that means at the end of, for year 1, we have to have $6,000 of working capital. So in year 1, what we're going to do is we're going to add back in $2,000. So now our working capital balance is $6,000, which is 20% of year 2 revenue. And there's a method to this madness, and you'll see how this all pans out. So in year 2, it's 20% of year 3 revenue. 20% of year 3 means working capital balance now has to be $4,000. So we add back in another $2,000 of positive cash flow. So what's our working capital at the end of year 2? $4,000. And then finally in year 3, 20% of $10,000 is $2,000. So we got to add back in another $2,000. So our working capital position at the end of year 3 is $2,000, 20% of 10. Now, what do we do in year 4? There's no year 5 revenue. So what we have to do is zero working capital out by now adding back in another $2,000. And notice working capital over the course of the 4-year life of the project is net 0. And we're showing the working capital it being expensed or the cash flow going out. But then as revenues drop, that working capital is reduced until the project is completed and it's all gone. So we're properly showing the working capital requirements in the years attributed to the revenue. Now, if revenue goes up, then we would need more working capital. But in this case, revenues are dropping, so our working capital base is dropping during the life of the asset. Clear as mud, huh? And that's how it works in the real world. Your public accountants, or if any of you have companies where there's internal auditors or cost accountants, they calculate that working capital rate. And in this problem, it's 20% of revenue. That's the working capital rate. So Look at what we've done now. We've now taken all the variables and we've completed our cash flow. So our cash flow now is going to be, in year 0, we're spending $45,000 on the asset and we're spending $8,000 on the working capital base. So we're dishing out 53 grand in year 0. And then in year 1, we're taking our net income, we're adding back in working capital and depreciation. And there's our working capital, or there's our cash flow for year 1. And let's just take that all the way across. And there's our working capital project cash flow for all 4 years. We're spending 53,000 and we're generating this cash flow, which is $62,000. Let's put that there. $62,000 of total cash flow off this investment over the 4-year depreciable life of this asset. Now we can take this information and do what we did in chapter 8. We've just calculated how we got $80 and $100. We just did that here. Here are those numbers. Now we can do the same calculations that we did in chapter 8. Does anybody, before I get to those calculations, does anybody have a question on how I ended up with this bottom line?
I have a question. With regards to the working capital, is it safe to say that you can divide that 8,000 by the number of years?
Well, you can in this case, but not in
It
any
doesn't
other
always
cases.
apply. Okay, so that's,
Yeah.
doesn't always apply. Okay,
Exactly right, Paulette. If you do that, you're going to get probably wrong. It's
okay,
in this problem, it works out that way, but usually it doesn't.
okay.
Okay.
Thanks.
And we'll, again, we're going to look at an example next week in class that's totally different. Okay. In most cases, most projects, revenue goes up every year.
Right.
This problem is a little bit different. Okay, and we'll look at an example like that next week. Okay. But that's a good question. Okay. So now what's the discounted cash flow? Formula, function, financial, net present value. What's our discount rate or our cost of capital? It's given to us in this problem as 12%. And what is our yearly cash flow? Oop, 12%, Mr. Hesse. 12%. And what is our yearly cash flow? Year 1 through year 4. Boom. C14 to F14. We're now including 4 years of cash flow, and we get $48,622.29. And if I'm a manager at this company, I'm now sweating bullets. Why am I sweating bullets? Because the net present value is the discounted cash flow as a relationship to the investment. Uh-oh, we're losing money. We're losing money. It's a negative net present value, $4,377, excuse me, and 71 cents. Where in chapter 8 problem, we had a positive cash flow or NPV. Chapter 9, uh-oh, we're losing money. So in this case, unless this company is in business to lose money for their investors, they have to go back to the drawing board on this project. Now, let me give you a real world example of this that actually happened, okay? And I won't give you all the specifics, but it's basically the same way. When Steve Jobs back in the 1990s had the idea to begin and set up iPhones, okay? They went through this whole process, the capital budgeting process of determining how much the investment would be to create an iPhone and the technology, what their anticipated depreciable life would be on that. In this case, it was 15 years. What the revenues they expected to generate off this phone and expenses, working capital, taxes, blah, blah, blah. And they did this analysis 7 years before iPhone came out on the market in the late 1990s. And when they came up with this analysis the first time, it was just like this case, but the numbers were greater. It was a loser, negative. And so all the people at Apple said, and Steve Jobs says, we are getting this phone to market. You guys figure it out how it's going to make money. And this is how they figured it out. They, first of all, the original plans were to build the iPhone in San Jose, California, where the tax rates of California and the federal government are quite high, where labor unions and labor costs were quite high. So the accountants and the financial managers of Apple Computer said, we can't build this product in San Jose, California and make money. Guess where we're going to make it? Anybody can guess? China. China. Because in China, there were no corporate taxes. In China, I got to watch what I say here, but it's true. In China, they were paying 16, 17-year-old people to build these products at very minimum wages. Yes, Apple Computer was using child labor to build the iPhone. Well, we'll let that go for now. But by building it in China with a company called Foxconn, Apple was to generate huge cash flow because they didn't have all that overhead, all that cost. So no way we're building it in San Jose. We're building this product in China. And that's how the iPhone got off the ground. They decided to build the product in China. But they did this analysis to make that strategic decision. Okay. You're not only learning about numbers here, you're learning about history. It's amazing. All right. Bader's back. Bader, get away from me. Okay. Let's do internal rate of return. Formula, function, financial, IRR. Remember, for IRR, all we have to do under values is paint from year 0 to year 4. Year 0, including the investment year, to year 4, and we get 7.5%. We're still making money, but are we making enough money? By one of the principles of finance called the investment principle, we have to generate enough return more than what it's costing us to get the money. It's costing us 12% and we're only generating a return of 7.5%. This is bad. That's why we're losing money. Negative cash flow, a negative present value, and our return is lower than our cost. We can't do that. If we approve this project as financial managers, our board of directors and our investors are going to say, what were you smoking when you approved this? We're losing money. We're not going to get paid any dividends off this project. What the hell are you doing? That's a problem. The profitability index. Remember, the profitability index is the relationship of discounted cash flow to the investment. Well, it's going to be under 1. I know that. Yep, 0.92. We're not even making enough money. The discounted cash flow is less than 1 of the investment. We're generating, by this ratio, 92 cents compared to a cost of $1. Not good. The payback in years. Let's see what that is. We're investing $53,000. Okay. In the first year, we're generating $20,900 of cash flow. So at the end of year 1, we still have $32,100 of the investment to pay back. In year 2, that 32.1 is going to be reduced by the cash flow in year 2. We still have $14,800. to pay back. Compare that to the year 3 cash flow, we still have $1,100 to pay back. So after 3 years, we still have a balance to return on our original investment. So that means looking at year 4, we have $10,100 of cash flow. So we know we're going to pay it back, the $53,000, sometime in year 4. And how you calculate that decimal? All you do is you take the relationship of the balance remaining, $1,100, and divide it by the cash flow of year 4, and that's 0.11. 1, 2, 3.11 years. That's the payback. 1, 2, 3, and then 1,100 is 11% of 10,001. So we're going to pay the $53,000 back in 1, 2, 3.11 years. And if you really want to be a geek, equals 365 days times 0.11. We're going to pay this back in 40 days of year 4. And if we want to be a real geek, what's 40 days? Well, there's 31 days in January. So we're going to pay this back on February 9th of year. I'm never going to ask you to do this. I'm just showing off. On February 9th of the 4th year, that's when it'll be paid back. But trust me, companies do this. They do this. Well, we're expected to pay back this back on February 9th of year 4. Who cares? That's too long. We want to pay this back in half the time. We're going into the 4th year before we pay back this investment. No wonder it's a loser. We're staying away from this one. I guess we better start building this product somewhere else if we want to build it, or find more revenue, or cut costs, or find cheaper money, or find lower taxes. These are the strategies. If any of you are going on to MBA school or getting your master's degree in finance or MBA and master's in business administration, this is what you study in your MBA. Okay, we've calculated the numbers. They don't look good. What's our strategy? What's next? And in the corporate finance that I'm teaching now, 6:30 for the MBA program, this is where we are in that class right now. We're now determining what strategies do we need to do to make this work, or if we can. But you guys don't have to worry about that. Your job is to come up with these numbers. So there you go, guys. We're starting into the world of capital budgeting. Next week, we're going to find out how we came up with this 12%. That's what next week's all about. Next week, we're going to find out about how we can make any little changes to this, maybe to generate and take another look at this. It's called scenario analysis. And then we'll take a look at those two things next week. How to determine the cost of capital, and what can we do to make changes called different scenarios. Right now, people at the University of Laverne are freaking out because our enrollment numbers are down. So right now, they're in the administration and in the people who are making strategic decisions, they're working on different scenarios to put together in the next couple of weeks to offset the loss in revenue in the coming semester. And what are those alternatives? Cutting faculty. What are those alternatives? Cutting other types of expenses. What are those alternatives? Is putting together better programs for students to attract more students. That's why people are paid the big bucks to be managers and leaders. They now have to come up with those strategies. And that's what they're doing right now at the University of Laverne. And that's what a lot of companies are doing right now in the pandemic, doing different strategies to offset the changes in revenues in the market. Catherine, you had a question.
I was just thinking that they're probably going to let go of some of their real estate that they lease for the in-person classes.
They've already done that. They've closed the Victorville campus and they've closed the Oxnard campus. That
Oh.
strategy has already begun. Now, are they going to be closing any other campuses? No, not for now. So I'm not supposed to tell you all this, but you heard it here first, okay? But they're not going to close the Burbank campus. They're not going to close the online campus. They're not going to close the Bakersfield campus, the Vandenberg campus, the Ontario campus, the Orange County campus. As of now, the strategy is just to close those two and see if we can get through this. And that's what they're doing. Now, I can tell you this because I'm co-chair of the budget committee for the faculty. So I'm part of this discussion. So I can tell you that. It's not a big deal. Okay. Destiny, you have a question?
I do. It's just off of curiosity. Do they make much profit off of commencements since there haven't been any commencements in the past 2 years? Has that been a factor at all?
Good question. I gotta watch myself here. To be perfectly honest with you, they've been losing money on graduations because they've been having graduations at off-campus facilities. If any of you remember, the last graduation this past spring was at a baseball field in San Bernardino. That was very expensive. Very expensive. And they mainly did it because they wanted to have the students to have some place for graduation. Right now, the plans are, because we're cutting costs, is to have one graduation a year. No longer having January graduations, just have a spring graduation, but really do it nice on campus at our football field with a nice ceremony, have the faculty there, students can have their faculty and have their families meet their faculty and do it in a good way and do it the right way, because graduations should be important to do, not this Zoom crap that some of us have been having. So the graduation in the last couple of years have been at off-site, away from campus. If they're on campus, they're very cheap, but if they're off campus, they're very expensive. So I think the management or the strategy is to have one graduation in the spring and have a real nice graduation for all students to come back and be able to take advantage of that. So I sounded like an administrator with that answer, and I apologize, but that's the best answer I can give for that, Destiny. Okay.
Gotcha. So would I be pushing it if I were to ask if there's going to be a winter commencement this upcoming year? Because that's when
Well,
I'm supposed to
right
graduate.
now, and again, I'll say this off the record, Destiny, this is off the record. Right now, they're planning on not having a January graduation.
Got it. Thank you.
It'll be in the springtime. Now, if I were you, I'd go ahead and ask anyways, because if enough students say, hey, what's up with this? No January commencement, I got to wait till spring. And then is that what we're going to do? If enough students, the reason why we have graduations at off sites is because so many students said, we're not going to have another Zoom graduation. This is ridiculous. We're going to have a graduation. You're going to have it somewhere. And they did have it somewhere. So if enough students want to have a January graduation, they will have one, but it's going to have to be an awful lot of students because that expense cannot be met by the current revenue streams of the university. God, I sound like a corporate clown, don't I? But that's a real answer there, and I'm being honest with you. Yes, Chris.
Thank you.
I think the biggest factor, at least amongst my coworkers, is everything going remote. And if I wasn't in my last two classes, I would be going remote through other schools. They'll give you full credit for everything at University of Laverne, and it's my reimbursement would cover everything.
Mm-hmm.
Instead of having, because I pay out of pocket quite a bit every year just to be on my thing, but I do it because there's a value to being in person.
Yes.
Whereas being remote, but if I'm going to be remote, why am I going to pay full freight?
Yeah. Well, again, and I'm going to be honest with you here, and you'll disagree with this, and I don't blame you for disagreeing. In my perspective, a lot has to depend on the quality and the value of the platform that's given to you. you can have a good professor who knows what he or she are doing. And in my experience, that can be just as valuable and just as good as being in a class and sitting in the back of the room and not paying attention anyways and listening to a professor. That's my experience. Now, I totally agree with you. You're not going to get value from every professor teaching remote because some of them do a shitty job. And I'm being honest with that. But you know what? Some of them do a shitty job in the classroom. So a lot has to do on your program. And I don't, Chris, you're totally right. And I totally agree with you. You're smart. You're looking for value. You're looking for a way of how to manage your personal expectations. And that's the way you should do. Okay. I think it's my philosophy. I wouldn't be teaching at Laverne if I thought students in my program were getting a shitty education. I would not do that. But I think what you have to do is you have to take the program you're in, the course of study you're in, and you have to take the value that you think you're getting out of it. Now, yes, I think we're going to have another semester of remote learning. Hopefully by next spring, we can go back to the regional campus classrooms. But I'm going to be perfectly honest with you. This is not University of Laverne's decision. This is the knuckleheads who aren't getting vaccinated decision. If we still maintain 50, 60% vaccination levels, we're going to be remote forever. I tell you, I'm not walking into a classroom where I know some students are not vaccinated because I have a wife who has cancer and I'm not bringing home any of these weird things to give it to her. I'm not doing it. So until people come to those terms, we're going to be on remote forever, like it or not. And I understand, Chris, that if you said, well, I'm not getting value, then I would look for another location. I would take a look at other areas of getting that value. So that's legitimate. But I mean, we have 50% of the employees at Laverne who are not vaccinated. Good Lord Almighty, really? Now I'm getting into political territories here, and I got to watch myself. But really? We're serving young people, we're serving experienced professionals, and 50% are not vaccinated? Really? Why are you in the education business if you're like that? Maybe you should find a different career.
Mm-hmm.
That to me is unacceptable. And I don't care about your political feelings. I don't care that you think this is a communist plot or whatever. But if you can't be an educator if you're in that situation, it's just like if I had my kids today going to school, do I want to put them in that situation? I don't think so. So again, it's personal preference, personal expectations, personal value, and that's what we have to work on. I just know from my perspective, I'm going to work my ass off in a remote setting to give you the best value that you can. And sometimes I succeed, sometimes I don't. And if I don't succeed, I want you to tell me. That's important. Paulette, you had a question.
I didn't have a question. I just wanted to just to add to your point of remote learning. I think I've had experience both types. One where a professor did a shitty job, and one where the majority
Sorry
of
for the language.
professors, excuse me, did an awesome job, including yourself. And
Well, it's not over yet. But that's okay.
I think that for the most part, it's it's all about yourself, as what you dedicate your time and all of that to what you're learning. But at the same time, if the communication is not there and you don't understand something, there's so many ways to communicate, not like with Zoom, with email, text. So you really have to be engaged with either communication, and the instructor has to be engaged with keeping that communication open so that all students feel comfortable reaching out when there's an issue.
Yeah.
And so that in my experience, I had a class where the professor just launched like 30 videos every week and the work. So you're exhausted. You can't watch 30 videos in a week on top of the work. It's excessive. So that's an imbalance.
No, I totally agree with Chris and his his feelings on this.
Mhm.
If I'm a consumer and I'm paying money for a product or a service and I don't feel I'm getting value, then I'm going to go elsewhere, or
Right,
I'm going to work within the system to make it better.
right,
And I totally
right,
agree with Chris on that. But I
right.
think sometimes we're locked in by the market, the economy, health, that there's no way around that. And we have to just do the best we can. And that's not really fair to you guys. I mean, you guys deserve a nice graduation. You guys deserve quality professors in every class. You guys deserve feedback on your studies. You deserve so much more than what you're getting. But you know what? I teach a class at SC. It's the exact same thing. And you're paying $70,000 there
Mhm.
and you're getting the exact same stuff. So again, it's where you go, who you have, and what's the situation. And as SC, you got to watch a lousy football team. So, I don't understand that one. But Chris is totally right. And I totally respect in what he said. I agree with him. But we have to find a balance. We have to find the platform that best
Works.
serves you guys.
Mhm.
And sometimes we succeed, sometimes we don't. But you guys deserve the best. No matter what, you deserve good quality. You deserve explanations. You deserve a nice graduation. You deserve career services. If you want to look for a job or use this as a job, you should be able to call up Robert, whatever his name is, in the career service office for Rock and get some answers and get some help in doing a resume or doing that. You deserve that. And if you're not getting that, the first person you should send an email to is Deborah Lieberman. Hey, I'm not happy with my professor. I'm not happy with this. I'm paying your salary. What's up? Give me some explanations or take care of this. You do exactly what Chris says. You take action. You give your opinion professionally, respectfully. But if you're not happy, you should tell people. I expect that of you guys. If I'm doing slack or you guys are upset at what you're getting, you should tell me that. Don't be intimidated by me. You just tell me, Mr. Hassey, I'm not getting this. You got to help me. This is not working. And you need to do that. Because the bottom line here is for your success, not my success, not Laverne's success, your success.
Mhm.
And if that ain't happening, we got to make it so. Okay, enough of the political Chamber of Commerce talk for the evening. I probably got in trouble by doing this. And by the way, this is being recorded, by the way, and it's going out on the YouTube. So there we go. Everybody's going to get all excited over this one. All right. So here's where we stand for this week. Okay. We've gone over, and I'd like you to take a look at these on your own. Take a look at the problem in chapter 8. Take a look at the problem in chapter 9. Try to do them on your own if you can, or just take a look and walk through how we did this. All right. And then look at my Road King video for this week on Saturday, because that'll help you and your teams get going. And then next week, if you can, try to read chapters 10, 11, and 12, the key points, and look at week 6 in Blackboard. It gives you the key points to study in that work, how to determine cost of capital, how to determine a scenario analysis. And then we're going to look at more problems and examples of this next week. And then you're going to do a practice problem as an assignment next week to practice all this. Okay? So this week, there's no graded work, so you can take a breather and not have to worry. I know you guys have been working very hard the last couple of weeks of all these assignments and midterms. Take a break, but stay in communication. Begin to map out your strategy and your work for Road Kings. Take a look at that video lecture. That'll help you a lot, trust me. And then we'll attack it again next week, and I'll highlight next week's topics in my introduction video to you at the beginning of the week. All right. So let me save this. And that's it. Anybody have anything other concerns or questions?
Sorry,
Rudy, good to see
Professor, for
you.
being in the dark.
Thank you, Rudy. You're a good-looking guy. You shouldn't be in the dark. That's okay.
My dog was going crazy and he finally fell asleep, so I had to stay in the dark. And now he's crazy again.
Destiny, is the Dodgers winning tonight? Are they winning? Give me a report.
Well, I was too busy focused on you. So let me check the score real quick. Their bases are loaded 4-5. Dodgers are down by 1, but they have the bases loaded right now.
Who's batting?
Justin Turner.
All right. Destiny just got an A in class participation for tonight. giving us an
Yes.
update of the Dodger game. And there's a chat question here, Melanie. Melanie, the video will be available probably in mid-afternoon on Saturday, around 2, 3 o'clock. Okay. That's when it'll be available. And I'll send you out an email when it's posted so you know to look for it. Okay. All right, everybody. Again, I'm sorry that I will not be available tomorrow evening for my office hours, student hours. But if you have questions, I'm available on the weekend, or just send me a question and I will answer it and get right back to you. But I will not be available in person tomorrow night. Dustin, where have you been hanging out the last hour and a half? Well, you disappeared. What's going on?
I was right here. There was just stuff going on, so.
That's all right. Do you want me to ask you that off the recording, Catherine, or do you want to ask the question now? Off the recording? Okay, I'll talk, you hang on then. I'll answer your question. All right, Destiny just indicated it's a tie game. Destiny, you need to get a life. You don't need to be watching the Dodger games. They're
It's
giving
almost
me-
October. There's no life other when it hits
Yeah.
October.
But last night's game was really good with the Giants and the Padres. I'm sorry.
I did see that game. That was a pretty good
Oh my
game.
gosh.
That was a pretty good game. All right, everybody. Have a great week. Stay safe. I'm sorry about the big political commentary of the earlier this evening. I hope I didn't freak anybody out or get anybody upset. So
No.
I have a great rest of the week, and I'll be in touch with you guys soon. Take care. Adios.
Pass on Professor tomorrow.
Thank you.
All right, thank you.
Yeah.